Hello, everyone. James, how are you doing today?
Doing well. Happy start of Q3. We're a few weeks in now, but second or first half of the year is all set away and done.
Wow.
Yeah, we're already on our way to 2027 almost. It feels time's flying fast.
Unbelievable. You are right on 2027. The market always discounts 6 months forward.
Yep.
So, well, we're going to have some fun here. We've got the third quarter 26 macro outlook. And as always, we like to start out by thanking all of our advisors, clients, and partners for the partnership that they have with us.
Yep.
And we couldn't do it without them. So big shout out. Just kind of 30,000 feet again. We're a team of 30 people. We have 5.6 billion in AUMs. That's managed money. If you include the assets that are with RIAs that do it themselves in retail, it's closer to 6 billion. 10% of the firm's assets are partners, which we think is a key feature. And half of the team of 30 have equity. So they're very much aligned with our advisors, our clients, and our partners. So the investment team, the core of the investment team, which are the myself and Jim Considine and Dick Fredericks. We've been there since the inception. And obviously we've got two other great additions on there, Daryl and Alex Varner. So key piece there that we have. And then the philosophy, the kind of key touchstones, again, costs, trust, price and proof rarely happen at the same time. I know you guys in the research spend a lot of time looking at that. And then it's time in the market, not timing the market. So with that, James, why don't you talk to us about the second quarter and the global asset class performance and what you kind of see?
Yeah, the biggest thing kind of start of Q2 was obviously the kind of near the bottom of this whole Iran war, Strait of Hormuz, all of the fear regarding higher oil prices. And basically a lot of the Q2 move that we saw was part of that renormalization back to, oil came down considerably. You continue to have the AI trade. You see the kind of top winners on the top there, even with commodities down 11%. They're still the top returning asset class for the year. Right behind them was actually EM. A lot of that was driven by some of your more tech-heavy emerging market countries. Think, Taiwan, Korea, these countries that have basically really tied into the AI ecosystem. Specifically, some of the memory players that you've seen do extremely well, and then more recently, we'll talk kind of over the past few weeks how they've done. But at least as of the end of Q2, as of June 30th, they had led the way. And then kind of going down the map there, your S&P 500, was up right around 10% at the end of Q2 for the year. And that was, we've actually kind of chopped around and it remained right around 10% through the end of like last night. One laggard that you have had has been bonds. You've seen aggregate bonds continue to be pressured by higher rates. You've seen that just yields overall just been pressured upwards, obviously tied to inflation, some fiscal concerns in there as well. But that's kind of the high level, what we've been seeing this past quarter and the first few weeks of Q3.
Yeah, we'll talk a little bit more about the bonds. Like you said, they're long-dated bonds. People have lost money year to date. And the short end of the curve there, they've barely made any money. So it's been tough. All right, what about when you drill down into the sector performance for the S&P 500, the 11 sectors? What do you see?
The sectors, it's kind of a lot of the same story. Your big three winners year to date, again, as of the end of the quarter, were industrials, technology, and energy. I think those kind of speak to three of the big themes that we've been seeing. Industrials and tech tie into this kind of global reindustrialization, AI build out, a lot of trillions of dollars going into these data centers and kind of broader manufacturing and again industrialization. And then obviously the other side of the coin has been oil. Energy. The energy sector is tied to oil prices very heavily, and that was the leader going into Q2. Obviously you saw some relief there as oil prices came down, gas prices came down, but even still they're right up there in the top three performers year to date. And as kind of a live snapshot, they're now the highest performer. So you've seen some resurgence in some of the oil prices and subsequently some resurgence in energy companies as well.
Yep. Yeah, and to that point there, the next slide here, we've got oil, which obviously now that the war is back on here now, we've got West Texas Intermediate trading in the mid 80s, up from the high 60s before the war. So it's still a hot situation. Now, what has happened, as we know, the U.S. continues. We are the largest oil producer in the world, bigger than Russia, bigger than Russia and Saudi Arabia combined. So it's not as much of an impact here. Obviously, gas is over $4 a gallon. We like to say that it's uncomfortable at $4, but the consumer doesn't really start to go crazy until it gets a 5 handle on it. And the previous peak here this year has been $4.50, but this is still anyone's guess here. I mean, we don't know what's going to happen in the Straits of Hormuz. We don't know what's going to now happen in the Red Sea. We don't know what's going to happen with Ukraine and the Baltic. So it's just every time it's like whack-a-mole. So having said that, the one thing that we want to keep in mind is I believe it was Monahan from Bank of America. He made this comment on the second quarter earnings that a year ago, CEOs had no idea about the tax bill. They had no idea about the regulations. They had no idea about the tariffs. They had a number of issues that were unresolved. All of those are all resolved, and the only piece from the war that's impacting them domestically is gas at $4 a gallon and the input in it. So that's a lot more manageable and a lot easier. So, all right, the next one, why don't you talk a little bit about the efficiency, the distribution, the usage, et cetera, that we have here from
So this chart specifically looks at the percentage of total consumer expenditures, what people are spending their money on, what portion of that has went to food and energy historically. And you can kind of see, since 1960, it's just kind of steadily decreased down all the way down to 11%. Now, when the data started, it was right around 27, 28%. That, I think, represents kind of the resilience of the consumer against things like higher oil prices. In the 70s and the 80s, and even a decade ago, higher energy prices would have eaten more of that consumer's kind of overall pie of their income or of their spending. Nowadays, there's so much wealth in this country and so much consumption in things outside of kind of those necessary non-discretionary goods. So, food and energy, it's kind of those, it's hard to buy more than you need for food and energy, right? You can try, but it's hard to really have much discretionary spending versus if you're going to go buy a nicer house or a nicer car or a boat or whatever it is, those things are discretionary. That's where people are spending their money. Also on things like, let me highlight it on the right here. Things like healthcare has become a massive part of the U.S. economy spending. A lot of that being, talk about the inefficiency of the healthcare system, but I think a lot of that also being focus on longer lifespans, focus on treatments, focus on, not just letting things kind of go for a ride, trying to actually address health problems. So that's a good example of discretionary as well, where you can afford to spend money on your health. You couldn't have, 50 years ago.
Exactly. So 2 other quick observations, then we'll flip to the next one. 2008, 18 years ago, gas was $4 a gallon. And that was in the middle of that last commodity bubble that was going on. But it's interesting, people's wages were a lot lower back in 2008 than they are now. So even though they like to focus on the absolute 4 as a percentage, it's like this shows it's lower. And then to your point, 21% now is on healthcare. I'm looking forward to AI and other technology innovations that'll drive those costs down and help it out. So
absolutely
optimistic about that. I'll hit this one here on rates. This is clearly, we have a new Federal Reserve chairman in Warsh. His second meeting, it's unbelievable to think it's already his second meeting is next week. And as we know, his mantra has been, since he got the position here the last couple months, has been price stability, price stability, price stability, and covered with no tolerance for inflation. So he's talking tough. The markets right now, the 2-year is at 4.3%. Okay. That means that there's 3 rate hikes baked in or predicted over the next 12 months. The Fed funds futures, and again, I like to use a 70% confidence interval. The Fed funds futures have 2 rate hikes over the next 12 months. The first in September, and the second in March at that 70%. And I kind of believe that the September rate hike looks like that's pretty much going to happen. He's not going to take it up here next week because he's got the June deflation that happened. But now that oil's back up again, I think September he's going to be, short of the war stopping tomorrow, he's going to be faced with that. But I think the market is anticipating and is priced for a rate hike and is probably going to be able to handle that. Now, if you tell me we've got 3 more behind that, that's a problem.
The thing you have to remember too is the most recent few rate cuts were kind of described as insurance cuts, right? Going into the year, there was a fear of the labor market cracking. There was a fear that the economy was falling apart. That didn't really end up happening. Whether or not that was really due to the rate cuts, I mean, kind of unclear, but regardless, the insurance cuts, as being described like that, logically, if the labor market is recovered, as we've seen and we'll cover shortly, therefore the cuts should be kind of reverted back. Right? Like logically, that's kind of what you should be doing. Will they hike 3 times? I don't know. I don't think it would take a lot for that to happen. It would take kind of a extended war, extended higher oil prices. Obviously, you've seen the past couple of weeks oil prices rebound, but is it going to last another year? Maybe, but it's not clear at this point. They're probably being very data dependent, like they should be.
Exactly. And to your point there, if there's 3 rate hikes put into the 2-year at this yield and you get a rate hike, the 2-year is not going to move. It ain't going higher next week or in September when that happens. And if anything, to your point there, maybe there's only 1 to 2 rate hikes, which means the 2-year yield actually will come down. So, okay. The next one here we have is this whole kind of rate volatility. And in this one is, again, if you look at what fixed income has done year to date, I took a look at the 2-year, which a lot of people are positioned kind of short duration. Duration is 2 years is definitely short. That is up 0.5% through last night. 0.5%. All right. Then you look at the 10-year and the 10-year is down 1%. Down 1%. And the 10-year is yielding 4 and change, and the 2-year like 3 or 4.3, but it's closer to 3.9 right now for that piece because it's a 1 to 3. And then the 20+ year is down 2%, and that's yielding 4.9. So you point out in here, you and the research team, we've got a buy right strategy that it yields 6. It's up 5 on the year. It doesn't have duration risk like the other credit instruments do, and it's got that durable income that's liquid, unlike private credit. That's an illiquid instrument. So it seems to be.
I think this is part of a much longer term trend where, for 50 years there was this idea of like the 60-40 with your bonds being the ballast and your equities being the growth, and your bonds were supposed to be inversely correlated and provide the income as you aged more and needed more of that income. And the past 6 years, like you really haven't had that role played very well by bonds. Obviously, you were burned in 2022 massively if you had any sort of basically any bond duration at all. And even this year, like it's up 0.5% or even down. Your equities are doing great, but basically everything else in your portfolio, if you're a 60-40 investor, is not. And people are thinking, well, how else can I get income other than just through these bonds? And there weren't the same level of or even the possibility of things like options writing or other liquid alternative strategies 75 years ago, when the idea of a 60-40 really came to the forefront. So things like the buy right and things like these liquid alternatives have become more popular under the realization of, I don't want my income coming from just one asset class, and one asset class that's very sensitive to inflation and very sensitive to interest rates.
That's right. And if you break that 70-year period up and you put it into two distinct periods, 1980 had rates that peaked in the high teens, the 10-year. So everybody got lulled into a false sense of security because for the next 40 plus years, rates did nothing but go down.
Exactly.
And what they got paid, they got not only the coupon, but they got appreciation. So they got kind of a double thing. And they said, this is a no-brainer. But if you talk to people that were investing back from the 50s through the 80s when rates were going up the entire time, they actually, to dampen the volatility in their portfolio, this is going to sound crazy, they increased the equity allocation and decrease the fixed income. So we don't think we have a 50-year, run, or a 30-year run with rates going higher, but you can clearly see as they're kind of bouncing along with a slight upward bias here. It's not like you said, the ballast.
Yeah, exactly.
So, all right. The next area here, why don't you take this with the labor market?
Yeah.
Let us know what's going on.
I mentioned this kind of, a few minutes ago, but coming into the year, the labor market was seen as potentially, weakening. You kind of saw this upward trend in the unemployment rate. What the traditional thinking is when you start to see that unemployment rate trend upwards, usually that continues for a long time, or up until a spike. And it's kind of fascinating how you can see it's really leveled off and just actually dropped back down to now it's at 4.2%. There's a few kind of factors under the covers of why that's been the case. Part of it's been lower, immigration, meaning lower labor supply. Broadly as well, I think the economy's just been stronger than a lot of people expected. You can see there's still been plenty of jobs being added every month. It's been 92,000 jobs added on average over the past 6 months. That's much ahead of what it was basically throughout all of 2025. So we don't really see the weakness that was kind of worried about in the beginning of the year. Another kind of thing naturally just talking about the labor market is how AI is showing up. It's not been widespread really yet in our eyes. You haven't really seen the widespread layoffs or widespread unemployment, obviously in the data, maybe on the margins in some of the specific areas like technology or straight out of school for white collar work. Like those are very specific areas of the labor market that maybe not are directly AI related, but somehow adjacent, but not really showing up in the broad statistics.
And the real-time ADP payroll data that I've been looking at here for July looks like it's kind of tracking to a 50 to 70,000 type of non-farm payroll. So in the zip code. Okay, the next one here is your CapEx super cycle. This has some very fascinating numbers that are on it. So why don't you walk us through that?
So this is a long-term project that we've been tracking. Basically, we've looked at these different kind of massive capital expenditure infrastructure projects throughout American history, going back to like the railroads in the 1800s, early 1900s, interstate highway system, the Apollo program, going to space and the moon, and then the broadband build out of the 90s and early 2000s. And we've tracked basically how much was spent in terms of capital expenditures in each of those different cycles from, call it year one to the peak in the capital expenditures. And the crazy thing about this AI build out so far is just the absolute scale and speed of build out. You can see that exponential, that blue dotted line or dashed line on the left. This is just looking at kind of the big five hyperscalers, your Google, Meta, Amazon, Oracle, and Microsoft, what their capital expenditures are per year. And most of this is going towards data centers. Obviously, there's some spending that they're doing outside of that for office buildings or whatever it may be, but a majority of it's going to these data centers to subsequently, run and build these AI models. And it's now estimated at over $3 trillion over the next few years is going to be spent on building these. And that's, an absolutely astounding number. It's where you're starting to see it show up in, we talked about how AI wasn't really showing up in the labor market. You're starting to see the CapEx numbers show up in the GDP, in the construction spending, in employment, in some of the areas of employment. Things like electrician wages, wages of construction in certain areas of the country. This much flow of capital is really, really impacting some of the parts of the American economy.
Oh yeah. Well, and clearly the choke point here on the speed side is going to be the regulation, because you have to get permitting for the land and the facilities, and then the energy, hooking it up, which is obviously why we've got SpaceX that went public last month there, and they're talking about eventually getting launch costs so that you can get up in space for the data centers there that have unlimited free energy, solar. They have no cooling issues, and it could be interesting, but we'll see what happens. All right. Next one here, we have productivity. Maybe I'll tackle this a little bit. As you point out here in this slide here, GDP, unfortunately, for the last 3 quarters, the second quarter hasn't been reported, or the last, 3 quarters, fourth quarter of last year and the first half of this year, it's been about 1.5%. Now, we know that part of the headwind there is we have no labor force growth. And in order, GDP is a function of the growth in labor force and productivity. So you got one piece that's stalled completely. The productivity looks like it's running around 2% and should actually be moving towards 4% eventually with AI as we get it coming downstream. As you start to see it implemented from healthcare, as we talked about, or you get it in finance. We're using the amount of AI that we're using here over the last 3 years has gone exponential.
Absolutely.
And again, I think, we I think have the right view, I would say, with AI, that it's ultimately a revenue enhancer. If people are just saying it's cost cutting, they got a problem.
I agree. I think what you've seen so far is that revenue enhancer. It's people saying, okay, how can I improve the efficiency of my job and take on more things? You haven't really seen the outright replacement. Often, what it is too, is it's employees having to go and do that themselves.
That's right.
No one's going to automate their jobs for them, at least at this point. Also, what you're seeing on the productivity side, obviously the spending has been much faster to build out. You've really seen that ramp up over the past couple of years. The productivity you're just starting to see pick up. Even 6 months ago, you started to see really things like the revenue of companies like Anthropic over the past 6 months have really started to ramp up. That's people, buying those AI tokens, actually implementing it. Probably a year ago, 2 years ago, it was more of a science experiment, still early stages. So that's going to be over the next kind of 6, 12, 18 months, more implementation, figuring out, where to fit AI basically in these existing structures and how people work. So we're excited to see how that shows up in the data.
And one thing we will see, and we're starting to see CEOs talk about this, the end of last year, the CEOs basically said, like you said, it went from kind of a skunkworks project with people using it to where the CEO said, token maximization for everybody. Now the bills are coming due, and a lot of them are saying, we might miss I'm making this up, but we might miss our quarter because we didn't realize it. So the second half of this year is going to be rationalization for the people that really need to be using it. Somebody that's just using it for an email or a slower turnaround time there, they can have a cheaper, i.e. free cost version, which is good because this will then force all the companies that are out there, they're going to have to rationalize their pricing.
Naturally, with any new technology, there's going to be inefficiencies in how it's built out. It's not going to be perfect from day one, and there's going to be learning pains or growing pains along the way. So you'll see that, I'm sure.
It's a natural evolution and progress line.
Exactly.
Why don't you talk about the fourth year of the bull market that we're in will end in October, and then we'll be looking hopefully at a fifth year of a bull market. If we get to that fifth year, what do the annals say?
So this fourth year, it's funny, you actually kind of are still tracking it fairly well, even with the drawdown in Q1. You're right around up 17% over since basically October of last year to today. That tends to be what the long-term average is for this fourth year is right around 17%. The fifth year is still really positive. It's around 12% on average. That's, above kind of the long-term 10, call it 9-10% return over the, very, very long term. So that's good. The average drawdown in that period as well, you do get some volatility. The average drawdown is right around 10% for that fifth year, which is slightly above average, kind of what you just see on any given year. So you can anticipate maybe it's higher upside, maybe there's some more volatility or more drawdown along the way when you're starting to get into the later stages of that bull market. We also look at, in this case, year 2 of the election cycle. Yep. Obviously, you're entering kind of midterms and the volatility associated with that. You tend to see some more volatility, especially kind of in Q2, Q3, kind of that April to October timeframe that we highlight on the slide there. Maybe we front run some of that in March and April.
That's what I was going to ask you. Looking at that slide, it looks like you front run the volatility. So do you think A, that is the case, and B, also looking at your chart there, it looks like we're going to lose 7-8% drawdown here coming up.
It is, one thing I'll say about the election cycle is it's not a hard and fast rule. Like
exactly.
If you look at the kind of bands any given year, they're all over the place. It's not a directly aligned, this is exactly what the return is going to be. It's more directional, more just in general. Okay, where's the seasonality? Where is the implication for what the market's going to do just off of this one factor? Obviously, there's so many other, millions of factors at play.
Exactly.
But I think it's informative just from a high level. Okay, where are we kind of on the roadmap?
Yeah, that makes sense. Next slide here, international returns. It looks like you've probably had some PE contraction and earnings growing more than the returns.
Yep. Yeah. So one of the things that we're looking at in terms of international is obviously part of your returns are driven by the dollar,
right,
and what the currencies are doing. You've actually seen year to date the dollar has not really weakened at all. It's been pretty flat, which relative to 2025, where you had a lot of tailwinds from that weaker dollar, that's actually a good sign for us, where you're getting international returns from things outside of just currency effects. It's actually like fundamentals of the companies, multiple expansion and so on. In this case, actually, the multiples of emerging markets have actually come down since the start of the year. Same with the broader markets, and developed have been kind of flat. And that's, a good sign as well. You want to see return coming from actual earnings growth. I mentioned it earlier, but that's being driven a lot by some of the emerging market technology companies. Again, South Korea, Taiwan, et cetera. But overall, I think we remain positive on international. You see really strong earnings growth over the next few years, especially in emerging, where we remain kind of overweight positioned. I think all of the factors are kind of positive there.
And I think to your point, I would just reiterate, like in 25, you had 10 points of currency. So it really didn't matter as long as you had international exposure and it wasn't hedged, you got paid. This year, to your point, it's country selection, which obviously plays into managers like ourselves that have country rotation strategies. All right. So the next one here on the international outperformance, if you look back here, going back to 1970, there are 5. We're in the 6th distinct cycle of outperformance. By my guesstimation, looking at this, you got 2/3 of it still to happen in front of us. So I think that's encouraging. I still notice with advisors I talk to, a lot of them still haven't. They've dipped a little teeny toe, but and that's in spite of the fact that for a year and a half now, all of 25, and like you just pointed out, half of 26, it has been outperforming. So I do think, the message to the advisors out there is that we still believe 2/3 of this duration is in front of us.
Yep, exactly.
So, all right, the next one, why don't you talk about the earnings estimates, which have been nothing short of phenomenal?
Yeah, I think one of the biggest stories this year, and some people have obviously been paying attention to it, but I think it's gone underappreciated, has been the earnings growth and how much those have moved up in terms of estimates. You're looking, Q2 earnings are just starting. You had some of the big banks reporting over the past couple of weeks. Those have been strong. You're now expecting 23% growth for Q2,
Wow,
which is
23.
absolutely massive. That's a year over year number. And then in terms of the kind of next 12 months, what you're expecting is right around 20%. That's also a massive number. Usually earnings are growing at high single digits,
Yep.
if not lower. So you're really seeing acceleration of earnings. And obviously that's what drives long-term returns for equities. So that's a good sign
Yep.
for the equity market. I think if we kind of move to the next slide.
Yeah, because you do some good work on this next one. People are worried that rate of 20+% is not sustainable.
Yep.
So what happens if it stays positive, but it rolls over?
Yeah. So what we looked at is kind of historically past 20 years, if the acceleration, or if the earnings don't accelerate as quickly, if it goes from, let's say, growing at 20% to growing at 10%, usually that's not really a bad sign for equities. It can be neutral, it can be good. Where you really have to look out for is the negative earnings growth. So that's like a 2008. Even in 2022, we went slightly negative on earnings growth. Those are when you have your kind of really, really nasty bear markets. It's your multiples contract and your earnings drop. So you kind of have both sides of the equation coming down. We don't really see that happening, right? We're growing at 20% earnings. If things cool off, which they inevitably will, we'll still be growing at double digits. That's kind of what 2027 is expected to grow at 17%. That's still very strong. So nothing short of kind of extraordinary so far. And as I mentioned, it's not a bad sign for things to cool off there.
That's right. And the message again to advisors is that that's a high bogey at 20, but even if you had a teenager year over year, 13, 14, 15, 16, 17, the market can still go up during that period there. Okay, valuations. This is kind of more like what we said in the international, but now looking at the U.S. market, we started the year at 22 times. We've had 19% earnings growth. And you've had a 9% multiple contraction. So I like to see that personally, because when you're in the middle of the bull market and moving towards the back half of it, you want it all to be earnings driven. The PE, you're done with it. You had the big, the PE expansion. This one came off a 15 to 22, whereas some of the real, ones that the earnings get clobbered, it goes down to 10 times. But you kind of get that the initial couple of years, and then years 3, 4, 5 need to have earnings driving it, which is exactly what we're getting. And in this case, it's even better because you're getting a slight multiple contraction. The earnings are growing so fast. So it's given us a little bit of a buffer, which I like. Talk about the recession watch. I see a piece of red that we have on there, but everything else is green and blue. Yeah,
we moved inflation to red back in May. That was obviously kind of off of the higher oil prices, the geopolitical conflict. And we've seen, even the past couple of weeks, oil just continues to be kind of this thorn in the side of the market. The market overall has been able to shrug it off pretty well, but there's definitely been certain areas that have been hurt and, also helped, of course. So that's our one area, kind of our risk area. If oil continues to be, higher than $80, $90 a barrel, that's gonna, basically what the cause and effect is higher oil prices means higher inflation, which means higher rates, which means lower consumer spending. So that's kind of the downstream effect, is people are going to have to spend more on their gas. Rates are going to be higher, so they can't take out their loans and buy their cars or houses or whatever it may be. And that's just overall going to kind of slow down the economy. That's not our base case. We don't think that's going to be necessarily happens. But it's something to watch for. That's the kind of, call it a gray swan in this environment, is oil prices just being higher for longer.
We're in the same camp as the rest of the market. When the war started at the end of February, and everyone kind of thought, okay, this thing can go on for a quarter and then we'll be okay. Well, we're 5 months into it now, almost 5 months completed, and the market has shrugged it off. And I think the main reason is because it really has been isolated down to gas at $4 a gallon, which is inconvenient, but still manageable. And the fact that the underlying economy has been so strong.
Yeah.
So again, you would hope that they get something resolved by the end of this year.
Yeah.
I don't know, but clearly the longer it goes on, there are unintended consequences that none of us know will happen.
Yep.
So that's the biggest risk. Okay. The next piece here, we're going to conclude it here with, our earnings forecast. This is the price target ranges for the forward 12 months. I just want everyone to realize that we've got the markets at 7,500 right now. The forward 12-month upside is 8,400 and the downside is 7,000. So in rough numbers, it's 2 times the upside, 12% upside, 6% downside, which is typically an attractive situation there. So I think, again, our advice to advisors and clients would be clearly if there's any, even at this absolute level and you're looking forward 12 months there, it looks attractive. Any pullback that gets you down closer to the low end becomes very, very attractive. So with that, any parting comments that you have for the advisors and clients?
I mean, I think, we're talking about price targets. The market overall, obviously you've had some rotation under the covers and, whether you're in the memory players or some of the tech or some energy, like those things have moved a lot, but it's funny. You look at the kind of headline market and it's been kind of flat over the last few weeks, even with all of this noise of the resurgence in the Strait of Hormuz, oil prices, memory, all of this, kind of noise. The kind of message there is stay diversified and stay invested, stay in your lane. Don't try to pick the single stocks and get burned when they reverse, when momentum, happens to reverse. But that would be my my piece of advice for the audience.
Yeah, I think that's very sage advice. And just want to end it with, again, we really, really appreciate the partnership. We are an open book here, and anything that we can do for you and your clients, just let us know. And thanks as always.
Thanks, Kim.